I don't want you to make this huge tax mistake if you're already taking Social Security. I want you to avoid taking a big tax hit if you're already taking Social Security and you're looking to take extra income out. We're going to do a case study today. We're going to go over a certain situation. We have a lot of people come in our office throughout the years. They're on Social Security. They're saying, well, I hear it's a great time to do Roth conversions. It is, but I want to understand what the tax implication of that could be. Or some people say, I only have $40,000 to pay off my house, so I just want to take money out of my IRA or 401k, pay it off so I don't have to deal with it again. So we want to show people the tax problem that could cause. Or people want to buy a car and take money out of their IRAs and 401ks. Remember, your traditional IRAs, your 401ks, 403bs, TSBs, deferred comps, you haven't paid taxes on that money unless we're talking about Roths, which we're not. You haven't paid taxes on that money yet. You got a tax deduction when you contributed, but when you take that money out, you have to pay taxes. It's tax deferred till you take withdrawals. So we just want to go over those situations, or maybe buying a house or putting money down on a house, or these certain situations could be a big tax situation to you. So I'm going to go over a case study here. We're going to put these numbers up on the screen. I just want to go over John and Jane Doe, right? We're not giving anybody's specific information out. We're going to go over a couple who are already both retired. So they're married, filing jointly. They have combined Social Security pretty good, $56,640 gross Social Security in their household. They also have pensions. They have a little bit of pensions of over $15,000. We'll put that number here up on the screen. And also they have some monthly withdrawals. They're not 72 yet, but they're taking monthly withdrawals out of their investments, about $17,218, less than $1,500 a month gross. So they have total gross income of over $89,000. So $89,594 specifically of just gross income. Now, I'm going to refer to, we're going to see how is Social Security taxed. I already did a previous episode on this, so we're going to have the link up here if you want to click on that and figure out how is Social Security taxed, so you can be up to speed on that, and then maybe check that link and come back here so we can go over this situation, but specifically how is Social Security taxed. Going back to that video, how do they tax Social Security currently? So I want to go over what is the situation now, what are the taxes today, and then if somebody took out 40 grand for one of these, car, house, Roth conversions, whatever it might be, what is going to be the cost to you to do that? I want people to understand that. So we'll compare the two. So if we look at that provisional income formula, remember they don't tax all of your Social Security. It's up to maximum 85% of that. So if you're married filing jointly, they have these two numbers, these two thresholds. $32,000 for married filing jointly. Anything above that, half of that can be taxed as regular income. And if you're over the $44,000 threshold, it's additional 35%, which gets you up to that 85% of taxable Social Security. So we're going to put these numbers up here. If they have $56,640 of gross Social Security, we subtract that $32,000, that means $29,274 is going to be, half of that will be taxed as regular income, which is $14,637. But we have to go over that second threshold as well. So you subtract that gross provisional income of $61,274, subtract the $44,000, multiply that by 35%, gives us additional $6,045.90, which we're just going to round it to $6,046, which gives us $20,683 of the Social Security is taxable. Now remember I said their gross Social Security is $56,640, but of the taxable amount is $20,683, which means right now only 36.5% of their Social Security is taxed. And that's on the federal level. Now remember, there are 12 states in the US that does tax Social Security on the state level. So that's going to be additional taxes as well. So when we look at this situation, and right now we look this on the federal level, they're paying $2,581 of federal taxes. On the state level, $4,001 of state taxes, which is $6,583 total in taxes under current situation. So right now, $6,583 of total taxes between state and federal, they're averaging, I like to look at the big numbers, 7.35 cents on the dollar. So for every dollar you make, 7.35 goes towards federal and state is the total combined on average. But now let's look at the same situation. If you're taking $40,000 to do one of these, these items, Roth conversions, buy a car, pay off the house, buy a house or down payment on a house, what will that impact you? And we're going to look at a state that does tax Social Security. So we're going to see the increase on the federal side, but also on the state side as well. When we look at the situation here, if you're taking additional $40,000 out of your investments, we have to look at the provisional income formula again. And we're going to put these numbers up here. But the interesting thing, I'm not going to go over every specific number. As you see, it shows on the provisional income formula up on the screen right now that says the provisional income formula is $54,687.90. What we want to just go over is you're not going to be taxed on $54,687.90 of your Social Security because that's almost 100% of it. There is a cap. So with Social Security, the max you pay taxes on Social Security is up to 85% of that. In this formula, the provisional income formula is well above 85% of your Social Security. So we have the exact number. It's pretty simple. 85% of your Social Security will be $48,144. Now, when we add that $48,144 along with all the other, the pensions and the investment income, now is what you can see here is taxes jump way up. And this is where I think a lot of people aren't, figuring, because in the first example, without taking any money for this condition, this request, only roughly, 36.5% of your Social Security is going to be taxed. You're going to see 85% is going to be taxed. That's a big jump. That's almost a 50% jump on what of that is taxed. So when you're taking out $40,000 out of an investment, you're not just paying taxes on that $40,000. Now you're paying taxes on additional Social Security that you were getting tax-free before, which a lot of people are not thinking about. So here's the numbers when it comes to the second example, taking that extra money out. Now the taxes, federal tax rate, you jumped in that 22% bracket. Remember, in these tax brackets, just because you fall into the 22% bracket doesn't mean you pay 22% on everything. It's marginal tax brackets. You only pay 22% on what you went over into that next bracket, right? You have federal taxes increase, so that went up to $11,561. You have state taxes had a big increase of $9,034 total taxes. So now you're paying $20,595 in total taxes. And you went from 7.35% average taxes. Now you're paying on average 15.89 cents on the dollar. You over doubled your average tax rate by taking out that $40,000. So by taking out $40,000, you've had additional taxes of $14,012 additional. So that's 35+% of additional taxes that you weren't paying before. We just want you to have some things to think about before you just go and do things. That's why it's good to work with somebody that can run these numbers for you so you're not just winging things and having tax issues. We just had somebody come in here recently who, with their current advisor that they're leaving, did a Roth conversion without going over any numbers, had no idea, and they have to take a bunch of money out of their investments to pay off the tax bill that she didn't know they're having because it wasn't fully explained. And this is why we want people to understand, we're for Roth conversions, but you have to understand the tax consequence. It might not be the best fit for you to do that. But we definitely don't recommend taking a big tax hit like this if you're buying a car, especially with low interest rates right now. It does not make sense to do that. Also, to pay off a mortgage, what happens in the back end of the mortgage? Well, all the interest is in the front loaded or in the first half of the mortgage. The second half is mostly principal. So if you only have 3 to 5 years left on your mortgage, most of your payments are going towards principal. I know you like to get rid of that payment, but taking out of an IRA or 401k is not the best place to do that because you're going to pay a ton of taxes when you're hardly paying any interest on that. There's other sources might be a better place to take it than that. A lot of numbers on here, but the really key to this is all the extra taxes you could be paying on Social Security on top of the other taxes you pay on just the withdrawal could affect your retirement. and we want that money to stay in those accounts and grow and multiply and compound interest on that as well. So just make some good tax decisions this year. Please hit that like and subscribe, and we're going to get you some great information this next week as well.